So this is the last paper of the day? All right.
Yes.
So I want to make it quick, 5 minutes. You can go home. Then I will take another 10 minutes to kind of explain the detail if you're really into this corporate finance story. So this is really about, it looked like a microstructure paper, and this is more like a corporate finance paper. So this is more interaction between trading on the stock market and investment inside a corporation. So this is my co-author is Xiamen University. This is a PhD student at Renmin University, and Casey John at Hong Kong Polytech. Okay, so I can use this, right? Okay, good. So the research question is: does trading activity matter for the investment activity on the main street, right? So think about it in the corporate finance theory that once the firm raised the capital after the IPO, it's pretty much separated from the trading activities. However, there is a relationship between financial market and the real economy, meaning the corporate investment. So this paper has studied it, but these are more cross-sectional evidence. So field study have actually estimated real impact based on some sort of exogenous shock to the stock prices, so that prices will drive the investment behavior within the firm. So the two famous papers, one is Edelman et al. 2012. They look at the mutual fund flow, right? So the mutual fund flow will drive the stock price changes, and that will actually drive the takeover. So that's very nice. So this is actually, because there's no direct connection between mutual fund investment and the takeover. So that's a very nice shock. And the second paper is Darren and Krzyzewski's 2013 is about the merger or closure of the brokers, right? So they will reduce analyst coverage because before it was 2 houses, now just 1. So the analyst coverage was reduced, and that will change investment behavior as well. So this is a very nice channel. So think about it. So in this paper, mainly we're going to study one of the regulation change on the stock market, the margin trading, and we want to see whether that will also drive the changes in the corporate investment within the firm. Right? So in the US, there is one famous experiment. So in the SEC, it was actually 2005, implemented in 2005. So that allows some of the stock in the pilot program exempted from short sell price check in that period. So there are so many studies actually study the real effects of that experiment. So these are just a laundry list of them. So the last one was really interesting about the small firm. So what they found was that for the small firm, when short selling increases, because they give them exemptions, so that price went down, and equity issues and the investment also went down as well. So this is a very nice causal evidence in this line of literature of the real effects of the trading to the real investment in the firm. So let's look at the Chinese experiment. So that actually connects nicely back to Coase John's model, right? So in China, the way it works is the government always worried that the market was a bad idea. So they always try to do this experiment, right? There's a saying is you cross the river by touching the stone and the water, so that makes sure you're not falling off. So the one experiment is that the CSRC, which is equivalent of SEC in China, they introduced this pilot program of margin trading. So before the pilot program, no stock can be trade on margin or short selling. So the pilot said, let's just include some of the firm that can be eligible for margin trading and short selling at the same time. So the purpose wasn't about corporate investment. The purpose was to see, because there's so many economists learn the market from the West, so they always argue that we should have a market that will help the corporate information to stop prices. So that's why we should allow margin trading. So the government said, all right, let's try it. So 90 stock was selected. Then after several rounds, and many stock was incorporated in this program. So there are studies already done to look at the direct effects, which is more or less on the microstructure areas, so that they do see once you have margin trading, the stock actually has better, a smaller volatility and higher liquidity. So this is more microstructure. So actually there's the Indian data as well. I hope everybody read this paper, very famous paper, is about the margin trading requirement changes in India, it also has effects on the liquidity improvement. So that's sort of similar to this. So the hypothesis is that the increase in the margin trading activity improves the liquidity and reduces information asymmetry and serves the cost of equity capital. So a more informative and high level of equity price will help drive down the cost of debt capital as well. So this is very interesting. So the investments of financially constrained firms are less responsive to investment opportunities because external financing is costly. Therefore, the benefit of reduction of this cost could be greater in this constrained firm. So overall, this we've already done this work is that price efficiency actually increased the firm that included in the pilot program. So they also look at the same experiment, but they are more studying the price efficiency, more asset pricing. So the increase in trading activity on the secondary capital market help reduce information symmetry and hence the cost of external financing. This in turn improve the profitability of the investment opportunity and basically you make those a more NPV, positive NPV investment so that, however, these effects will depend on the degree of financing constraint at the time of the shocks in the capital market, okay? So this is what I said. You can go if you feel like you're done. So this is the summary of the results. So basically what we found was the level of the investment, including capital investment and R&D expenditures, which related to the innovation, the increase after margin trading and short selling is allowed. Okay, more importantly, the effect mainly coming from the margin trading. So this is very interesting because in China, these pilot programs say you 900 firm, you can trade on margin and short selling. But we look at the data, it turns out 99% of the volume are the leverage, margin trading, only 1% of activity are actually short selling, which is kind of reflect the, I don't know, it's the speculative nature of the Chinese stock market. I guess other emerging market, in my experience, similar things is more speculative trading than short selling. So in order to disentangle these two issues, so we use the leverage mutual fund ownership to instrument for the margin trading, and we also find a positive relationship between margin trading eligibility and the level of investment inside the firm. Okay, so then we found a positive relationship between the margin trading eligibility and the corporate investment, and this is very significant in firms with high degree of financial constraint. We're going to test that. And we attribute this willingness to increase capital and R&D expenditure to that firm can raise debt capital at a low cost. So this is something I'm going to show you. So this is the history. So we're going to look at the pre-eligibility and during, which is sort of like a post, right? So the pilot program is very messy because not all the firms are included in one time. So it's just done like gradually. This is typical Chinese reform is nothing can be done like in one shot. It has to be done in phases. So we have to do it differently. One is using balance sample, meaning the guy was included in the pilot all the time. So we only have 150s. Then we have unbalances, meaning like everybody who was included will be in this treatment group, right? So this is the subtle. So we're going to use a univariate test for this long-term members, and we just run the regression for the any member who was any firm who was included in the pilot program. So then we collect all the data from the SISMA database. So this is actually just a summary of those firms before the pilot. So this is the before the experiment. So the pilot group and the control group. So if you see the difference, I put the star if the one of the pilot is significantly different to the control. You can see this is a typical helping hand in an invisible market, invisible hand market. So the Chinese companies, the government typically do this in almost every experiment. They pick the stronger ones and give them the chance to do some sort of experiment. You can see larger companies, higher marketed book, higher profitabilities, higher cash flow. Okay? The only exception is the leverage. There's no difference in leverage. Okay? So we really can't do much because this is what it is. So the only thing we can do is we can try to control them, because now we're comparing sort of a different treatment and control firms. So that kind of gives us a challenge. So this is just a different diff for those 150 guys that has been in this pilot program during all the periods. So overall, before and after, you see 4% increases of the investments, capex, and for the treated firms, and 2% for the pilots, roughly. So then the different diff basically is like before and after. You take the differences, it is still positive, meaning even after comparing with the control firm that wasn't included in the pilot, so you basically had a higher investment after this experiment, which is really had nothing to do with corporate investment, right? It's the microstructure regulation changes. So then also we use the capex plus R&D, which is kind of small difference. You think about the difference between the two basic is R&D, so it's a less than 10%. So that, but again, the increase in investment for those pilot programs, the one that are allowed margin trading, are having higher investment changes. I will finish that 5 minutes. All right, then, so that was the 150 versus the control. So this is just a regression from the DID, right? So you have a pilot, you have a post, then you have interactions, right? So what the focus is on the interaction, but the samples is different. This is more like the larger imbalanced one, meaning everyone used to be in the pilot will be in the sample, right? So we focus on the interaction term. Basically, you do see higher effects for those guys who are included from pilot and is after the pilot, during the pilot, meaning the post. So this is very, so then the worry was with the margin or short selling, right? So in this case, we try to look at the margin buy level or changes, right? So we found there's a higher margin buy and margin activities does create more capex. We also look at the short selling that was in the appendix anyway. So the main result is coming from the margin activities, not from short selling. So then we also do the two-stage least square sort of, so saying if the leverage mutual fund can only do invest in using margin to invest in these stocks, so they will create the margin activities, and that will drive the capex, right? So the theory is that the mutual fund activity doesn't really affect the capex directly, but it does affect through the margin activities. So this is sort of a nice way to tease out the causal effects. So we first stage was a little weak using the level, but using the flow has a significant effect in the first stage. So basically saying is more mutual fund flow create more margin activities, and they drive up the capex in this two-stage least square sort of setup. So this is another one. So now we try to understand the channel, right? This is the typical channel is that, so the change in the informativeness of the stock prices will give more information to the managers, so which has been done in this informativeness has been done in this paper, so that basically the theory that the pilot program enhances the liquidity and information efficiency of the stock price will lead to a higher capital allocation. So this is the typical channel. But we think it's more interesting to look at the financing cost channel. So we look at the financial constraint, a high constraint, a low constraint. We do see a high constraint benefit more. So you can imagine we use the Kaplan's and Gala's slightly different to the first paper measure of financial constraint, but we would believe this is easy to use. So the theory is that if the firm is financially constrained, now their stock can be margin traded and short selling at the same time, but mainly coming from margin trading, so they benefit more from the more liquid stock price. So the cost of debt also benefit. So the theory is the more informative equity prices and high level of prices is also associated with low cost of debt. Remember, before was the cost of equities, now is the cost of debt. So we collect the cash flow from financing, so debt and equity. So we do see more cash flow from debt financing after you're including the pilot, but not much changes in the equity. So mainly the story was the cost of debt was reduced, so more financing coming from the debt. But still, one of the side story was that raising capital through equity channel is still very challenging, not as easy as debt financing. That's just a side story of it. I had a paper on this issue. Basically, the government actually had the important role of approving some of the companies raising capital from equity or not. So that's a different story. So finally, this is the final slide, is investment become more sensitive to Tobin's Q. Therefore, the investment efficiency is improved so that you can see once you are including the pilot, the market prices will be affected, will be the effect from the market to book ratio, which is a measure of sort of, it's called the investment Q sensitivity, is higher, so the capex is increased. You can imagine this is more like if you are allowed to have margin trading so that the investment efficiency is improved so that the capex is improved. So overall, we try to identify the exogenous policy shock using the recent removal of margin trading for some of the companies and to see that actually reduce the firm's financing constraint and the cost of capital so the company will have more capital to invest in their corporate capital investments. So that what's the implication, which is I really like, is that there's a direction of growth-oriented reform policy in China. So that they need, the goal was to relax the external finance constraint so to allow the capital to the best investment opportunity. But the point is that the government actually has a role in this, right? So it's not relying on the market to do so, but the government actually influences as well. Thank you.
Thanks for having me. Really appreciate being back in Mumbai. And it was great to read something that really gives us an insight into how these developing markets are operating and what kind of changes we can observe if we change the way, or seeing this flow from the way we trade to how companies actually make their investment decisions. So I think a very good job was done in explaining of what's going on, that we have this change in how margin lending is occurring. So previously I had to have all my own money. Now I can kind of borrow stock and buy using some kind of leverage. We also have a relaxation in the ability to short sell. What they find is that this kind of changes how managers are willing to deal with their capital expenditure and R&D. So effectively they're investing more based on the fact that people can trade their shares even more. And so they attribute this to this kind of mechanism that there's maybe more pricing efficiency. So there's maybe an easier ability to access capital. So they think, okay, well, now they can invest maybe more easily. It seems, though, as we just saw towards the end, that the main channel that we're seeing here is they're able to access more debt. Okay, so as Nathan pointed out, there is some restrictions on doing secondary equity issues in China. So it seems that somehow there's something that's going on, that when we allow a lot of this margin trading, that we see more debt coming along. So I'm going to talk a little bit about that. This is the Shanghai Composite Index through the period that they are analyzing. So they're analyzing from 2006 to 2014. A rule change comes in somewhere in 2010. So I always liked looking at this with my Chinese students in Australia because there was a couple of these really big bubbles and crashes, right? And so I kind of use this when I'm teaching a little bit about market efficiency. I say, okay, the PE ratio of the market got to 100 to 1. What does this tell us about the expected return? Okay, maybe it's 1%. Do we think that the Chinese market is going to grow so fast? They say, yeah. Okay, well, eventually it crashed, so maybe not. What I guess this can tell us a bit about is that there is a bit of a different construction of the Chinese market. It tends to be a bit more of a, or in my experience, in my understanding, a bit more of a gambling market. So gambling is forbidden in China. Okay, we have heaps of gambling in Australia, but gambling is forbidden. So what do? They kind of take this outlet to the capital markets. And this can cause this kind of irrationality, if you like, within the prices. And during this period, as we've heard, short selling was quite constrained. So they start to loosen that short selling. And I'm going to just show the Bitcoin price here because it's a bit of a shameless plug. I'm going to talk about Bitcoin tomorrow. But what we saw, where I've put that little dot just before we get the peak and the crash, is the ability to short sell Bitcoin. Okay, so similar to Chinese stocks, when you have the inability to short, this can really feed bubbles because you get this positive feedback loop. Only those who own it can sell it. It becomes very difficult to constrain prices. That's why we can get P ratios of 98 to 1, or why we can get Bitcoin prices that go up to 10 million or whatever, 5 million rupees and then drop back down. So I'm trying to understand what's driving the result that we're seeing here. So we have this thing that allows us to short, it allows us to margin lend. The majority of what the activity that we're seeing is like 100 times more margin lending than what we see in shorting. So then the effects are most likely driven by whatever margin lending is happening. Margin lending is going to allow me to maybe push up prices, right? So, okay, maybe there is some evidence externally of increased pricing efficiency, but it's unclear why better pricing efficiency is going to lead me to change the way that I operate my firm. So then you can think about, okay, well, who's likely to use margin trading then? If we say, okay, we've generated increased pricing efficiency, well, why is it? Is it that the informed participants previously, those people who really have some true understanding of the fundamental value of the firm, they were constrained from trading before and now they can trade? Well, if they're really well informed about fundamental values, presumably they're going to win more frequently, right? If I know true value, I'm going to win more frequently. I'm going to accumulate capital. I'm going to be able to bring that back into the market. I'm not going to be as constrained by margin lending. Okay, well, what about speculators? Maybe if I'm just going to go bet on stuff, then margin lending is going to be very useful for me, right? I'm really going to prefer that. So now we can think about, okay, what's this maybe channel that we're seeing? Well, we're allowing some firms to have, let's say, these kind of speculators gamble on the price. We have a lot more margin lending than we have shorting, so we're likely to see these prices kind of come up. And that's one aspect that I didn't see in the paper that I would really like to see, is what happens to the returns of these firms. We're looking at these things over very yearly periods because we have this, we want to look at accounting data that's, I guess, granularity is typically yearly. But what if all I'm doing is putting gamblers into the market? Okay, I put these gamblers, speculators into the market, I give them the ability to raise huge leverage and to dump it into different kinds of companies. Well, if they're gamblers, what kind of firms are likely to be rewarded in that case? Well, I think it's those firms who are willing to take more risks. Okay? So this is what I think might happen. Sorry, my pictures are not the most amazing. I think we allow margin trading. This allows some gamblers to come into the market, and the gamblers are going to prefer stocks that have higher, let's say, variance of returns. So perhaps I prefer those stocks that take on more risky projects. We see that they leverage up with debt. So the firms are levering, and then they need to do something with the cash. They lever and they throw it, maybe even at value destructive, NPV destructive, I'm not sure, this is another thing that I would love to see the paper examine, is what are the kinds of okay, we've got more CapEx and R&D, but are these profitable projects, or are they just throwing their money at potentially value destructive lottery tickets because the gamblers or speculators reward them for doing so? So I think it's possible that they're undertaking actually more risk, and that if I'm leveraged, I don't really want like a really safe, I don't want to invest in something that's just doing government bonds with leverage. I want to invest in something that's got some lottery ticket optionality to it. So I think this might be the channel of what we're seeing, why these firms are basically levering up. We see that they're increasing debt, not increasing equity, significant increases in debt. They're spending that money on some kind of projects, research and development or capital expenditure, some new projects. Then what I want to know is, well, what was the outcome of those projects? Or what happened to returns? What happened to profitability? These are the things I think that really, we've seen what the channel is, but I'm not sure that the channel necessarily tells us something that's going to be useful for emerging markets, for example, like India? Would we suggest that based on this research, that somewhere like India should allow margin trading? Well, it depends. All that we've shown is that when we allow this margin lending, we end up with more capex and R&D. But the paper is silent on whether this capex and R&D increase is a good thing or a bad thing. You simply just say, well, there is a change, right? The firms change their behavior somewhat, but we don't know if that change in behavior is actually value accretive, if it benefits the firms, or if it just changes the composition of the projects that they're undertaking. So, if we think more R&D and capex is good, then yeah, we should encourage all developing markets to go do this. But, if we're just essentially encouraging higher leverage in more risky projects, then it depends on the outcomes of what flows back through from those things that they're undertaking. So that's where I'd really like to see, something a bit more about the returns of these firms who increase their capex during these periods, and something maybe about the value of these projects. Can we extract some more information from the accounting returns, look at if they're making some abnormal returns, maybe compare them to other similarly levered firms, right? What's happening to the leverage ratio? Are they just loading up on more risk and just slightly changing the composition of what they're undertaking? Yeah, so that's all I had. I left some minor notes there that are of more of an academic nature, which I'll share with Dathan after. Yeah.
Thank you. Okay, 2 questions. Go ahead.
Then I wanted to say that you showed us the characteristics of the treatment and the control firms, and you showed us that the characteristics differ significantly. In that case, it seems to me that you are not allowed to do those regressions, keeping these as controls. Those regressions are tantamount to extrapolation. So they're as bad as our normal regressions in economics, and you could graduate to a far more impressive research design by then doing matching. So what you should be doing is matching between the treated firms and the control firms, and discard the firms where the match quality is poor, and then you get a good data set. So that would be a far more credible design. The second thing I wanted to say was that you have a very beautiful feature in your experiment, which is the staggered introduction. So there are different firms coming in at different times. That makes possible an absolutely beautiful design where you would do a matched DID in event time, where you would pool all these different people surrounding an event date of induction into the program. So you match them and you express it in event time. So now not only have you purged the difference between treatment and control, but you also purged the effect of macroeconomics, and that would be really nice. So I feel that there is a very nice design opportunity in this paper, and you should take it.
Thank you, Nathan. And I really enjoyed the discussion. And sort of following on from what Sean was saying, I think it would be really helpful to step back and to take a view on some of the institutional characteristics of the Chinese stock market and their impact on efficiency. So if we look at the Chinese stock market more broadly, and look at the companies that are listing on that stock market and see that most of them are state-owned enterprises, right? And in that context, we have data gaps in those SOEs. We have difficulties in researching the SOEs privately. And so when we're thinking about, external informational sources, rating agencies, for example, are underdeveloped. The ability to glean information from credit prices is underdeveloped. And so when these mechanisms of market efficiency that we would consider to be quite important are missing, then and then we're putting this margin trading within that context. And so I kind of, looking at Sean's discussion, I kind of worry what the impact of this is going to be from the kind of stability perspective. In other words, like if everyone is trading on margin and there's a lack of external information in the market, then are people very sensitive to negative news, right? So is the potential for sell-offs magnified because brokers or whoever else is going to do the lending is extremely nervous about the leverage they're putting into this market and would want to get that money back as soon as they detect any kind of negativity because there's just such an information black hole in the market. And so I guess it'd be really helpful to just put some institutional context to the paper in terms of being able to situate what it's saying.
So good. All right. Good.
Yeah,
All
we're
right.
good.
So let me respond to the question first, and we'll go back to this, because we do try to do matching. So we actually start a paper with the matching. The problem with the matching is that the government are very pro-growth, meaning they pick the strongest firm into this pilot. So we don't get good match. So the problem is it's like you rank all the stock in India, you pick the top 50, you include them in the pilot. So we did all that, then we found there's no way you can match like market value or anything like that. That's why we basically saying is this is the special treated, and the rest of it will be controlled. So that's the best we did.
I'd just say that really does violence to the paper opportunity.
Yeah. So this is what we did in from the matching. We still have the matching exercise there, but we decided to take a different route and to do. That's a fantastic suggestion. The staging, we actually had similar things to do with that. So for every period you have a post. So like the post is dynamic, not like 1 year post. Yes, we had that. So the institutional characteristics, this is a complicated story. So. In China, they have this dynamic circuit breaker sort of thing. So anything fell below 10%, for example, in 1 day, they just stop trading. Even margin trading can be dynamic as well. So that you could literally, one firm can be banned for margin trading just because they had the circuit break alarm. So this is what Chinese does is the government is deeply involved in the market. Basically, anything goes wrong, they just stop the market so that you are not allowed to do so. So you can argue that's a bad thing, but that's institutional knowledge you want to know. But that's something they try to protect because overall the stock market in China is sort of a way to promote growth. So anything good will be helped. The government will try the best to give you the opportunity. But if anything goes wrong, the government just try to prevent things go worse. So that's the institutional background. I don't know if it's good or bad. For the discussion sides, and I really like the argument that the speculative gambling behavior. So we actually did a test in some of the, so we don't really find the gambling behavior based on distribution of the stock prices, but that's just one of the big tests, but we have to look at the detail about whether they are taking the negative NPV. That's a very good suggestion. But the point here is that we're not even going that far. So we're basically saying, does that induce like Ko's model was? Is it something just want to taking risks so that we can promote more innovation? Sort of the idea. Not really getting into the detail yet in this paper at this point. Yes, the cost of debt was one of the major reasons. It's not really the equity part of the story. It's the cost of debt was really being leveraged, being used as this opportunity because the higher stock price pumped up. Could be by the gambler behavior so that it helped the companies get more debt capital. But we didn't go ask the question, how do you use the debt capital, right? So we're just saying they're going to invest, and, right? So we did not. So I think that's a good way to look at the stock return, the outcome of this project that will actually make the story more complete. Thank you so much.